Today's topic is timing the market. We often get the question from clients and friends about whether the stock market is too high or too low. In fact, I was in the bank yesterday, and the bank manager was sitting there watching CNBC. And while he's watching CNBC, he looked over at me and he said, "Cary, you're in the financial business. Don't you think this market's in a bubble?" And I looked back and I said, "You know what? I don't know." And quite frankly, there's prognosticators on both sides of that equation who say the market's too high, the market's in a bubble, and there are folks that say this market could run significantly further than where it is today. The real life answer is probably somewhere in between those. And if your financial advisor is doing their job the right way, they're not worried about where the stock market's going to be next week, next month, or even next year. They're identifying what your long-term needs and goals are. They're creating a portfolio that is optimized so that the risk management matches the target return for your individual portfolio, and they're not concerned about what's going to happen in the stock market in the short term. The bottom line is, in my experience, what we've usually found is that when you try to make predictions about the direction of the market, you're generally wrong about 60% of the time. And when you're wrong 60% of the time at anything, it's not the world's best track record. My best advice to you is pay little attention to what's going on CNBC or what's going on in the overall financial media. Invest for the long term, buy good quality securities, rebalance them when your advisor indicates it's a good time to rebalance, and don't pay any attention to all the noise and news that you might see on the TV or in print.